Is it hard for you to manage your corporate finances? Do all your budgeting plans inevitably fail? And do you find that you or your team have overspent? Are you worried because your corporation or LLC has no buffer at all? So if something bad were to happen, for instance, bad revenue days, you would be really worried about making payroll and paying the lease? Have you never had the ability to acquire other businesses to grow your own? Does acquiring or buying business assets for your company sound like a challenge? My name is Laksh Bell, and today we are talking about a simple framework that we use here at Westernston to manage our corporate finances, keep a tight leash on our budgeting strategy, and make sure that we always have enough saved up for rainy days as well as for situations when we need to buy business assets or acquire other businesses. We are going to show you exactly how we manage that in this video. But first, I'd like to offer you our 6-point strategy checklist that you need as a small or medium business owner or leader in order to formulate your strategy or reevaluate your strategy and make sure that you're not missing any of the important aspects of your business or your industry that you should be considering. So, the financial framework. The thing about good frameworks is that they're simple and easy to implement. Today, I'm about to discuss with you a framework that only the most successful corporations use, even though it's equally as simple for you, the small business entrepreneur, to use it for your own company to manage your finances and make it all a breeze. Entrepreneurs often find finances boring. They want to do the exciting part of the job, which is either doing the work that their clients are paying them for or discussing things with their clients or making sales calls if they are very entrepreneurial. Finance seems to be relegated to the backwaters of accountants and other professionals of that field. Entrepreneurs who don't really understand finance cannot really grow their business beyond a certain point because they end up inevitably becoming an employee or a manager of their business instead of an entrepreneur and a leader. Often, growing to the next level simply requires having a good balance sheet and your financials in order. So today we are discussing a framework for you to get your financials in order without spending a lot of time, without devoting a lot of mental energy to it, and while making it a seamless process for everybody in your business to abide by. Let's get started. The core of this framework is that you need to have not 1 or 2 or 3, but 5 different bank accounts for your company or your LLC or your corporation or your corporate entity. No matter how you run your business, no matter what kind of legal structure you have, you need to have 5 different corporate bank accounts. And here's what they are. The first account that you need is revenue. All your revenue streams should be pouring in to this one corporate bank account. That's all there is to this one. That is the only purpose of this bank account, is to collect all your revenue and to give you visibility about exactly where and how your revenue is coming from. Now, the first big mistake I see all small and medium business owners making, and even large companies making, is that they have the same account for their revenues and their expenses and their acquisitions, and that's a big mistake because things are going to get haywire very quickly. What you need is a dedicated account just for revenue so that first, you can keep control over your finances, but secondly, more importantly, you have visibility about where it is that you're making your money. What is it that's contributing to your top line? Next, you need 2 different accounts for your expenses. One for your fixed expenses and one for your variable expenses like marketing and cost of goods sold. The fixed expenses are things like payroll, rent, lease, salaries, bills, so on and so forth. The things that you're going to have to spend money on anyway each and every month, and it's more or less fixed. Now, the reason why you want to have different accounts is twofold. Of course, the first reason is visibility. Once you have separate accounts, it's very simple to look into the dashboard of just one account or to log into your net banking for just one account and take a deep look at exactly where it is that you're spending money. But secondly, and far more importantly, is your budgeting. If you have a singular account for your revenues and your expenses, you never know how much you've spent in a given period of time. So you cannot control your budget realistically. However, you can never spend more money than you have in a bank account. So if you have a dedicated account for expenses, you'll be able to control those expenses from the point of origin, which is revenue. Having a separate account for your expenses, or in this case, two different accounts for your expenses, allows you to put a spending limit which is independent of how much money you make. Now, you obviously want to spend more money on advertising, for instance, when your business is growing, but having a separate account for that allows you to dedicate as much money to it as you are comfortable spending, and gives you a lot more control without having to think about it every single time you make a purchase or an expenditure decision. So we're up to 3 accounts now. The first is your revenue, the second is your fixed expenses, and the third is your variable expenses. And you're controlling how money is flowing from the first account to the next 2, from the revenue account to the expense accounts. Now, let's talk about the fourth account. It's your buffer account. And this is something I've never seen almost any business having. If you look at a person and you ask them about their bank accounts and they tell you they've got no long-term savings account, you'd probably be like, not a very smart guy. But when it comes to corporations, very few actually have a buffer or a saving account for the rainy day. And you already know that in businesses, you almost always have rainy days sooner than later. My own personal go-to strategy is to take everything that flows into a revenue account and take 10% of that and make it flow into the buffer account, so that we are protected for the months when revenue slows down or stops altogether. In fact, my current buffer is so strong that my business can continue to pay me, all my vendors, all my suppliers, all my bills, all my fixed expenses, as well as every single team member for 12 months. We have a 1-year buffer going on right now. So if our revenues were to drop by 100%, we would still be okay for 1 year before panicking. And that's a very, very comfortable position to be in. Now, let's say you want to buy an asset for your business. You need to buy a car, or you need to buy a camera, or you need to buy some computers, or you need to buy real estate. Where does that money come from? If you're taking it out of your revenue account, you really have not much of a control, and you're not really going to be able to build up that capital to be able to make these acquisitions from time to time on a regular basis. What you need is a fifth account, which is what I call an acquisitions or investments account. Right? This is where all the investment money comes from, whether it's assets that I need for my business or it's equity that I'm investing in other companies. So those are the 5 different accounts that you need. Money from the revenue account flows into, first and foremost, the buffer account, about 5 to 10%. And then about 5 to 10% into this account, the investments account. And then we distribute the money into our fixed as well as variable expense accounts. And this is the one that gets the lion's share of whatever is left, because this is where marketing is. And we like to spend as much money on advertising and marketing as we can, because that's the key to growing the numbers in this revenue account. So we don't keep much money in the revenue account, but we have a lot of money in the buffer account, and we have a lot of money in the investments account. What we don't have a lot of money is the fixed expense accounts, because those are fixed. Even the variable expense accounts, if you're really savvy and if you have a really successful business, you can break it down into 2 different things: marketing and every other variable expense. Okay? All your other variable expenses you want to minimize, while you want to maximize the amount of money that you're spending on advertising, with certain conditions being applied to that statement. Of course, you don't want to waste money on advertising. You only want to be spending money on advertising campaigns that work. And that's our 5-point framework. And that's how you make your life so easy as an entrepreneur. Every time revenue hits your revenue account, distribute it into your 4 other accounts. So that's it for this video. Go ahead and open up your 5 accounts right now. And before you do that, don't forget to download our 6-point strategy checklist that you're going to need, whether you already have a strategy for your small business or not. If you don't have it, you can formulate a new one. And if you already have it, then you obviously know that you need to revisit your strategy from time to time, and the 6-point strategy checklist from Westernston is what you need. My name is Laksh Bell. If you like this video, hit like. If you didn't like this video, hit dislike. If you have a comment, question, suggestion or complaint, leave it in the comments below and subscribe for more videos like this every day on the Westernston channel. Thanks for watching.